Hello everyone, this is Shivasagar S, Assistant Professor of Economics. Today's topic is a general one in terms of understanding your money and banking, and this is something that always is repetitive, that is the quantitative instruments. Especially there are three certain rates which you all need to be aware of: repo rate, reverse repo rate and marginal standing facility, or also called as penal rate. So, repo rate, okay. So, repo rate in the sense repurchase agreement rate, okay, repurchase agreement rate. So, what happens here is repo rate in the sense, so RBI banks borrow from people, okay, banks borrow from RBI and banks also lend loans which they have acquired from deposits, okay. See, when banks borrow from RBI, it is of short term lending, like short term borrowing as well as long term borrowing. Long term borrowing, bank RBI charges with what kind of rate? Bank rate. For short term lending in terms of RBI, borrowing in terms of all the member scheduled banks, okay. So, scheduled banks will also borrow, unscheduled banks will also borrow, but there is a slighter increase in the interest rate for unscheduled banks, okay. This is what happens here. So, when it comes to repo rate, repurchase agreement rates, here it is the rate at which RBI lends to commercial banks. Commercial banks borrow from RBI, RBI lends, okay, lends to commercial banks for a short term period of time. Repo rates in the sense, actually they are going to keep their securities. Commercial banks are going to keep their securities, okay, keep securities, or let's say their assets out of, let's say if a bank has 1000 crores of total demand liabilities, if a customer is coming, he is asking 10 crores of loan. So, what does it do? Repo rates, it can only borrow 1% of its total demand liabilities, that is 10%. So, it will keep the securities with RBI with an agreement. What is that agreement called? Repurchase agreement, that it will buy it back with a predetermined date. On a predetermined date, commercial banks may buy that loan back. Okay, repo rates typically may be 1 to 14 days, 14 to 30 days, or more than 30 days also. Okay, you have repo rate, that is 1%. If they want more loans for a period of 14 to 30 days, they can also ask long term repo. This is also one of like long term repo, it is for more than 1 month. If it is for within 1 month, that is 14 to 30 days, you can ask for term repos. Term repos, okay. Banks can avail term repos, that could be, okay, term repos, okay, term repos for 14 to 30 days, okay. So, here it is a short term liquidity management, it is a tool to control inflation and money supply, okay. How does it control inflation and money supply? So, money supply, if they want to control, they have to use what kind of policy? Contractionary policy, contracting the loan or contracting the money supply by increasing the repo rate, repurchase agreement rate. When the quantitative instruments such as repo rates are higher, no commercial banks will be having incentive to increase their borrowing. So, contracting that, if they want to pump the money supply, what happens? Repo rates are being reduced low, okay. So, low repo rate adds up to cheaper loans and growth stimulus. Higher repo rate, costlier loans and inflation control, okay. So, whenever economy is progressing, you have a expansionary policy with lower repo. Whenever economy is in recession or in downswings, you have higher repo rates, okay. Currently, there has been a change, 5.5%. See, there has been a reduction in repo rates. This is the current affairs topic, because now you can see most of the time from last months, it's a third consecutive times repo rates have been reduced, which we will discuss at the end of the video. Reverse repo rate, it is the opposite of what repo rate says. Back then, who was lending? RBI was lending to commercial banks. Here commercial banks are going to park their surplus funds. Okay, see, you all are aware that commercial banks are supposed to maintain reserve requirements in the form of CRR, cash reserve ratio, SLR, statutory liquid ratio. But in addition to that, of course, let's say 100 rupees is the deposit, 22.5 percentage, 18.5 is your SLR, 4.5 is your 4 percentage is your CRR, that is 22.5 percentage. Okay, so out of 100 rupees. So what happens here is, other than that, there are certain reserve funds that which they will keep for liquid adjustment facilities, and they may have excess funds. Okay, excess funds, or you can call it as deposit surplus funds. To increase their percentage of internal rate, they may keep that particular funds. Okay, it could be in the form of cash, it could be in the form of assets, it could be in the form of financial instruments. When they are parking it, if government is increasing reverse repo rate, and the interest rate that is earned by commercial banks will be higher. Okay, so during the contractionary policy, one positive things that is happening to commercial bank is higher reverse repo rate will give them higher internal rate of returns. Okay, so but typically what happens, repo rate is always going to be more than reverse repo rate. Okay, so always it is reverse repo rate is lesser than repo rate is greater than reverse repo rate. Okay, reverse repo rate is always lesser than repo rate. If our repo rate is 5.5 percentage, which is the current repo rate, you can see reverse repo rate being much lower than what it is. Okay, so between 25 to 50 basis points. Okay, basis points in the sense 100 basis points in the sense 100 percentage. So 50 basis point in the sense 50th percentage. Okay, so that is how it is calculated. Now they have reduced to 50 percentage. That we'll talk at the end of the video. So one more thing is marginal standing facility rate. Like I've already said, your repo rates are of two other types. You have repo rates where you can get 1% of the total demand liabilities. If a bank is having 100,000 crores as its assets, they can actually keep 1% of the securities with RBI, and they can get repo. And if they want one more percentage of loans, they can use term repos. Let's say 1%. Okay, 1% is 10 crore. One more customer is coming and is demanding a loan. So again, this commercial banks will pledge 1% of their total demand liabilities, and they are going to use term repos. Okay, so again, let's say another customer has come, and banks do not have that much of cash. So what do banks do? Banks typically ultimately resort to MSF, marginal standing facility rate, marginal extra standing facility rate. That means what banks will do, again they will pledge their securities or any kinds of financial statutory liquid ratio requirements or reserves with them, and they'll get the loan, one more percentage loan. But you can see that in repo rate, the banks, RBI is charging 5.5%. It will be slightly higher. It will be, let's say, 5.75% interest rate will be charged. Okay, this is overnight borrowing. In a single day night, they are going to borrow this loans. Okay, why repo rates and MSF rates are important? Because every fortnightly RBI sends its auditory committee in order to check the balance sheets of the government, whether balance sheets of the commercial banks, in order to know if they have maintained SLR, if they have paid CRR, all those things. To manage those liquid adjustment facilities, commercial banks resort to this kind of things. Okay, so scheduled commercial banks. Okay, and even unscheduled banks can also avail this benefit, but their interest rate would be slightly higher charged. Okay, they will be charging more. RBI will be charging more. If it is 5.75% for scheduled commercial banks, they may charge slightly higher, like 7% or depending on the leverage of the unscheduled commercial banks. Okay, so this is also called penal rate, because when you are resorting to MSF rate, it also talks about your bank's status. Okay, penal in the sense penalty. If you are not maintaining your bank status, you do not have a robust banking transmission. It talks about that you do not have actual resources. It is backed by your securities, and you have utilized every tools in order to borrow money. Okay, so penal in the sense, the other name of it is called penal rate, penalty rate. Okay, so the current affairs for this topic is, for the last 2 months, you can see that RBI Monetary Policy Committee has reduced repo rate by 50 basis points. Again, it is starting to reduce. Last month it was around 6%. Now it has reduced to 5.5%. It is not only the first time, it is the third consecutive rate cut that is signaling strong shift towards an accommodative monetary policy to spur growth. Okay, how do you spur the growth? Decrease in the repo rate will in turn spur automobiles production, industrial production, industry production. Okay, and one more thing has been set down. Sanjay Malhotra's MPC committee, the governor of RBI, what does it target? 3.7% reduction in inflation rate. Okay, so projected inflation rate should be reduced to 3.7%. That is the targeted goal of this monetary policy committee, which has held recently. Okay, and one drawback is, so even though it will decrease the price, lending rate will be reduced for the customers, because our repo rate should be followed by all the banks as well. Okay, so monetary transmission rate is going to be slightly higher, but all these positive things are happening. One negative thing is sometimes fixed deposit customers may be affected because of the interest rate transmission. Okay, so that is one thing, and they should look for or diversify for different kinds of high yielding investments other than what they conventionally deposit in a bank. Okay, so that's all we got, folks. Keep watching our channel. Thank you.